Welcome to the Deep Dive. Our mission, as always, is to take a stack of source material and really unpack what it means.
That's right.
And today, we're looking at a piece focusing on the UK economy. Specifically, there's been this string of, well, surprisingly positive data points recently.
Yeah, unexpectedly good news in some areas.
But the interesting thing, and what we're diving into, is why economists seem so deeply divided on what this actually signals for the future path, particularly thinking about 2025.
Exactly. You look at the headlines, things like retail sales up, confidence ticking up. It seems positive on the surface.
Right.
But when you dig into the analysis, the expert commentary in these sources, you find this huge disagreement. Is this, real sustainable recovery or just something else, a temporary blip?
And that's the journey for you today. We'll lay out that good news, give it some context, because the UK economy's had a bit of a bumpy ride, hasn't it?
It certainly has, a real seesaw.
And then we'll get into the core arguments. Why are some economists feeling, well, maybe cautiously optimistic? And why are others still quite skeptical?
It's a perfect example, really, of how you can look at the same set of numbers, the same data, and come away with very different conclusions. Depends what you focus on, what you think matters most.
Okay, let's get into it. Starting point. This positive data. What specifically came out, say, last Friday, May 23rd, that caught people's attention?
Well, the big one highlighted in the piece was the retail sales figure for April. It showed a 1.2% increase month on month.
1.2%. That sounds pretty strong.
It was definitely stronger than most forecasts, and it kind of pushed back against some of the more downbeat predictions for, economic activity in 2025 we'd seen earlier.
And it wasn't just a one-off good month, was it? There's a bit of a pattern emerging.
Yes, and this is an important bit of context the source brings out. Retail sales volumes, the actual amount of stuff people are buying, have apparently risen for 4 months straight now.
4 months. Okay.
Yeah, and the piece notes that's the first time we've seen a streak like that since way back in 2015, if you sort of discount the really weird ups and downs during the pandemic.
Right, ignoring the pandemic noise. 4 months feels more significant than just, say, good weather in 1 month, though we might come back to that.
We might indeed. But alongside the sales figures, there was other news adding to this, let's call it, positive picture.
Like consumer confidence.
Exactly. GfK's Consumer Confidence Index, which has been running for ages, it also showed an improvement in May.
So people weren't just buying more, they were also saying they felt a bit better about their own finances, the economy generally.
That's the implication, yes. A slight uptick in sentiment.
And how did the markets take all this, the combination of sales and confidence?
Pretty well, actually. The reaction was quite immediate. Sterling, the pound, it jumped about 0.6% against the U.S. dollar almost straight after the numbers came out.
Creating around $1.35.
Around there, yeah. Which basically shows the financial markets were reading this data as, genuinely positive news for the UK's economic prospects, at least in the near term.
Okay, and there was one more piece of potentially good news mentioned. Something hitting people's wallets directly.
Yes, the energy prices. Ofgem, the electricity regulator, they announced that prices are set to fall by about 7% starting in July.
7%. And the thinking there is?
Well, the source suggests it's a tangible benefit for households. The average monthly bill is expected to drop by around £11 or so.
Doesn't sound huge maybe, but across the whole country.
Exactly. It adds up. And the potential impact is that it frees up household income. That £11 a month multiplied by millions could theoretically be spent on other things, boosting demand elsewhere.
Okay, so let's tally that up. Retail sales volumes up 4 months running, better than expected April figures, consumer confidence nudging higher, markets reacting positively, and cheaper energy bills coming soon. That does sound like momentum building.
It does on the face of it. For the immediate picture, yes. But, and this is crucial for understanding the split among economists, we really need to put this in the context of the UK's economic journey over the past year or so.
Which has been, as you said, a bit of a seesaw.
Totally. The source reminds us, we've had periods where the economy unexpectedly shrank. There were big worries about government spending plans, fiscal policy. It hasn't exactly been plain sailing.
No, but it hasn't all been bad news either, right? The source mentions some other positives.
It does. It balances the picture. There have been other positive data points scattered through, and it mentions the agreement of some significant trade deals with the U.S., India, the EU, things that are meant to help in the longer run.
And just before this latest retail data, we had other key economic figures land too.
Yes, important context. The economy actually grew by 0.7% in the first quarter of 2025. So, positive growth.
Okay.
But at the same time, domestic inflation figures for April showed it surging to 3.5%, still quite sticky.
Right. 3.5% is still well above target.
Definitely. And then just the week before the retail data, we got the earnings figures.
Yeah.
Average earnings, wages, they were reported as growing by 5.9% annually.
Ah, okay. So growth is positive, inflation is sticky at 3.5%, but crucially, wages are rising faster than prices, nearly 6% growth.
Precisely. And that mixed growth happening, inflation nagging, but wages finally outpacing inflation, gives you a much more complicated, nuanced backdrop than just looking at, say, 1 month's retail sales number in isolation.
And it's because of this complex picture that this latest batch of good news is being read so differently.
Exactly. Which brings us to the divide.
Right. Let's unpack that. First, the optimists. The economists who look at Friday's data, maybe combined with the recent trend, and see genuine positive signals. What's their main argument?
Their core view, as reflected in the sources, is basically that this string of positives, the retail trend, the confidence tick up, maybe the energy price drop coming, points pretty clearly towards decent economic growth carrying on into this quarter, Q2.
And Alan Monks at J.P. Morgan seems to be in this camp. What's his specific reasoning?
Monks thinks these elements could give Q2 growth a significant bump. He's forecasting something like a 0.6% annualized gain. And his logic leans heavily on the household savings rate.
Savings, how does that fit? I thought we were talking about spending.
Well, his argument is that households built up quite a lot of savings during all the recent uncertainty, pandemic, inflation shock,
Right, people were maybe being cautious.
Exactly. So there's this pool of savings sitting there. Monks argues that now, with confidence improving, even slightly, there's potential for people to start unlocking those savings, to dip into that buffer.
Ah, so it's not just about income from rising wages, but also drawing down on that accumulated cash cushion.
That's the potential mechanism he sees. And he looks at the details within that May confidence survey, things like people being less worried about losing their jobs, inflation expectations easing a bit, and crucially, people saying they intend to spend more. He sees that as evidence consumers might actually be ready to start using those savings.
Makes sense. And Rob Wood at Pantheon Macroeconomics, he had a pretty punchy reaction.
He did, yeah. The source quotes him reacting to the retail numbers, saying something like, well, now that challenges the idea of a cautious consumer.
So for him, the sheer strength of the spending data just flies in the face of the narrative that everyone's still hunkering down.
Pretty much. It directly contradicts that idea of households keeping their wallets firmly closed.
And Ellie Henderson at Investec, she saw the energy price news fitting neatly into this more positive story.
Yeah, she specifically flagged that off-gym announcement about lower electricity prices. She sees it as a clear, concrete improvement for household budgets.
Freeing up cash.
Freeing up cash that, could well be spent elsewhere, reinforcing that idea that the consumer can keep driving things forward.
Okay. So the optimistic side sees genuine momentum, improving confidence, rising wages, unlocked savings potentially coming into play, helped along by lower energy bills. Seems plausible.
It does, but it's definitely not the only interpretation out there.
Right. Let's cross the street to the more cautious, maybe even skeptical camp. What are their counter-arguments? Why aren't they convinced by this seemingly good news?
This is where it gets really interesting, because they look at the same data and see different things. Take Alex Kerr at Capital Economics. He puts out a strong warning, basically saying the sun won't shine on Britain's retail sector forever.
Suggesting that April boost was temporary? What's his reason?
He drills down into why retail sales might have jumped so much in April. He acknowledges the 1.2% rise, the 4-month trend, sure. But he argues that April's strong performance was, and this is the key bit, largely driven by the unusually warm weather.
Literally the weather.
Literally the weather. The source even adds the detail that March and April apparently had the most sunshine since records began.
Wow. Okay, so he's saying it wasn't necessarily people feeling richer or more confident, it was just nice weather getting people out to the shop.
That's his core argument for caution about the April number. He's basically saying, look, this weather effect is temporary, it won't last. So he suspects retail sales growth will probably slow down again, even if confidence did tick up slightly. He's wary of reading too much into that 1-month spike.
That's a very different take. It highlights looking behind the headline number.
Absolutely, what's driving it. And then you have Andrew Wishart at Berenberg. He throws another quite provocative idea into the mix about consumer behavior itself.
Go on. This sounds intriguing.
Well, while others are pointing to improved confidence fueling spending, Wishart kind of questions that link. He suggests the connection between sentiment, how people feel, and how much they spend might actually be broken right now in the UK.
Broken. How so?
Partly because, he notes, even with the recent uptick, overall consumer confidence is still way below where it was before the pandemic hit. It's still quite depressed historically.
Okay, so if it's not confidence driving spending, what does he think it is?
This is the striking bit. He puts forward the idea that, quote, depressed British consumers have resorted to retail therapy to cope with their economic and financial woes.
Retail therapy. So spending because they feel bad, not because they feel good.
That's the essence of his theory. It's quite counterintuitive. He argues that consumers spent the last couple of years really shoring up their finances after all the shocks, pandemic, inflation, rate hikes. They built up savings to a level, he says, was previously unseen outside of periods of mass unemployment.
Right, that high savings rate Monk's mentioned too.
Exactly. But Wishart interprets the reason for the current spending differently. He thinks now, having built those buffers, people are spending maybe because the environment feels slightly less terrifying, but the underlying motivation isn't deep optimism. It's more like coping, letting off steam.
That's a fascinating, slightly concerning perspective, and he thinks this has implications for interest rates too.
Yes, and again, it's counterintuitive. He argues that if consumers are spending strongly, even for these retail therapy reasons, it actually makes the Bank of England less likely to cut interest rates.
Why? You'd think if people are stressed, rate cuts might help.
Because the bank might just look at the strong spending data itself, see it as a sign the economy is holding up, and worry that cutting rates could add more fuel to inflation, regardless of the complex psychological reasons Wishart is suggesting might be behind the spending.
So strong spending, paradoxically, could keep rates higher for longer in his view.
Oh.
Okay. And there's one more strand of caution mentioned from Janet Mewey at RBC Brewing Dolphin. She brings in the government, right?
She does. She looks beyond the consumer. She acknowledges, yes, wage growth beating inflation is definitely helping households right now, allowing them to spend more. That's a positive. But, she says, you can't ignore the bigger picture. The state of Britain's public finances remain a constraint, the government's own financial position.
And how does that act as a constraint on the outlook?
Her point is that because government borrowing costs are higher these days, there's a bigger risk down the line of needing tax rises or having to implement cuts to departmental spending to balance the books.
Ah, so potential future austerity measures.
Potentially, yes. And those sorts of actions, if they happen, would obviously act as a drag on economic growth in the medium term. It's a headwind waiting in the wings.
Especially, as she apparently notes, when you factor in ongoing global stuff like trade uncertainties. The source mentions the Trump trade war context.
Exactly. So her caution comes from looking ahead at these bigger structural and policy risks, not just the current consumer spending pulse.
Okay. Wow. So we've covered the good news, the sales, confidence, energy prices, and then heard completely different reads from economists. You've got the optimists like Monks and Woods seeing momentum, unlocked savings.
Yeah, focusing on the household side, the wage growth.
And then the skeptics like Kerr saying, hang on, it was the weather. Wishart suggesting retail therapy, and Mui pointing to future fiscal clouds. So let's bring this together. What does this whole deep dive mean for you, our listener? Why track this expert debate?
Well, I think it's just crucial for understanding that economics isn't, simple arithmetic where 2 + 2 always equals 4. The data comes out, but the interpretation is where the real action is.
The same numbers, totally different stories.
Exactly. It shows how complex it is. Experts look at the same figures through different lenses, different models, different historical context, and they prioritize different factors.
So for you listening, it helps you see behind the simple headline. You hear retail sales beat expectations. And now you can ask.
Yeah, you can ask. Okay, but why? Was it a one-off, like maybe the weather? Is it broad-based? Is it sustainable? Does it align with how people are actually feeling? Or is there a disconnect? What are the counter-arguments? What clouds are on the horizon?
It just gives you that more critical filter, doesn't it?
Yeah.
To understand the layers involved in trying to figure out where the economy is actually heading. It's not just about the data point itself, but the whole web of interpretation around it.
Absolutely. It's about appreciating the uncertainty, the different forces at play, some pushing up, some pulling down. Policymakers like the Bank of England have a really tough job trying to navigate these mixed signals.
Okay, so let's try and sum up the core tension here. We've had this genuinely surprising run of positive UK data retail sales up for months, confidence improving, energy bills falling. Reasons for some optimism, for sure.
Definitely. Signals that the household sector is proving quite resilient, helped by that wage growth finally getting ahead of inflation.
But, as the sources make crystal clear, economists are really split. Some see this as the start of, or continuation of, solid growth, maybe fueled by people finally spending those savings.
While others pour cold water on it, saying, hold on, maybe it was just the sunshine, maybe people are spending out of stress, not strength, and don't forget the government might have to tighten its belt later, which could hit growth. And this leaves us, and you, with a really interesting tension to watch, highlighted right there in the source material. On one hand, you've got this potential boost from households' wages up, maybe energy bills easing, possibly savings being spent.
The potential engine for growth.
Right. But pushing against that, you have the constraint of the UK's public finances, higher borrowing costs, the looming possibility of future tax hikes or spending cuts, a potential brake on growth.
So the big question really becomes, which of those forces wins out? Will the consumer resilience be enough to power through, or will those wider fiscal and global headwinds ultimately prove stronger? That's the key uncertainty for the UK's path in 2025. Something to keep thinking about.
Indeed it is. A lot to track there.
Thank you for joining us for this deep dive.